And you're like, what does that mean? What does that mean?
Yeah.
What does that mean? And we literally had to go and Google those things. Hi guys, welcome back to another money discussion with Skilled Financiers. My name is Lindy and this is Tando, and together we are Skilled Financiers. If you're joining us for the first time, we're so excited to have you here with us. Make sure you follow us on all our socials, that's at Skilled Financiers. And for all the podcast lovers out there, make sure you're following us on all podcast platforms, listen to us on the go, and make sure you don't miss an episode. If you're someone that loves us on YouTube, make sure you click that notification bell. That way you don't miss any new discussions. So tell the people what we're talking about today.
Yeah, so today we are going to be talking about some of the jargons that you might come across, especially as a first-time buyer, where you are on your journey to buying a property. There's going to be a couple of words that may be used or terms that are used that you may not know the meaning of or may not understand the impact of those terms on your journey. Now, I used to work in the banking sector, and I was kind of like the person you spoke to before speaking to the mortgage advisor. So I used to essentially help people understand the journey, understand exactly what they were getting into, and then when they were ready, then I will pass you over to the mortgage advisor. So that was my job. So I kind of basically have first-hand experience that sometimes in this environment, it's easy for people to kind of speak to you like you already know like what these things mean. So yeah, so we're going to kind of touch on a few jargon terms and terminology that are used on your journey towards buying a house, especially if you're a first-time buyer, and terms that you may not necessarily have come across, say, in other scenarios, but they just say to you, like, you're meant to know what they are. So hopefully this discussion will help you understand some of these terms, but also help you on your journey to buying a house and kind of know exactly, okay, that's what that means, and therefore this is how this applies to me. Yeah.
So let's jump straight into it. So, in the early stages, these are like the very, very early stages before you even sort of like choose your house and stuff. There's certain things that you probably need to have in place. So let's start with things like deposit.
Sure. I think the deposit, obviously, that's very straightforward. People know what a deposit is. I think maybe the confusion that a lot of people have is that how much do I need as a deposit? And this is one of those chicken and egg kind of questions, because the amount of deposit you need is calculated based on the house price that you're buying. Now, generally speaking, you need to put a deposit of 10% of the price of the house that you're buying. But obviously, if you're still early on in your journey, you haven't found a house that you want to buy. So then the question is, well, how much should you save? To be honest, I think the stance that we took was save as much as you can. And then when you reach a certain level, so I think we kept saving until we found a property that we're like, oh, actually, this property could be good. And it happened to be that we had enough saved to put a deposit for that property. And therefore we made the jump. But I think there's kind of no right number to save, but just bear in mind it's 10% of the house price that you're buying, and the more you save, the more options you then have. Because imagine if you have a £15,000 deposit saved, that will give you up to £150,000 house for a 10% deposit. Or you could put that as a 5% deposit for 300,000 if you wanted to, that kind of thing. So it depends, right?
But the
more you save is the more options you then have to the houses that you can afford to buy.
And I guess it's important to also highlight that when it comes to a lot of new builds, they tend to be on more of the 15% deposit side rather than the 10. But you will find out those things like when you're now in it and you're like, whoa, okay, so this is how much I need.
Exactly that.
But I guess the next thing that's super important to then highlight is the agreement in principle.
Yeah. That's another good one. So an agreement in principle is it's basically like getting a pre-check to find out if you can get a mortgage. Now, there's different names for this, but all names finish with in principle. So it's either mortgage in principle, agreement in principle, or decision in principle. But really all this is doing is checking, can you get a mortgage? And if the answer is yes, you can, how much is that bank willing to lend to you maximum based on the numbers that you've put in place? So it's more of a check, really, an indicator. But then what you can then do with this agreement in principle is that it gives you the confidence that you are likely to be approved for mortgage, and it also gives you the confidence to go to, when you're putting an offer in, for estate agents to just know that yes, you actually can get approved for mortgage. But it's also good if you do get a no answer. It's not obviously it's unfortunate news, but at least the good news is that at least you found out early in the journey.
Yeah, true.
Rather than finding a house, making an application for mortgage and then being told no at that point, you're finding out early in the journey that actually I've got some things I need to work on. It might be that you need to improve your credit score, or it might be that you just need to save more money for a deposit to be able to borrow the amounts that the banks are willing to lend to you. So that's really what an agreement in principle is. It's a quotation or a check of, can you get a mortgage? Yes or no.
And I think an agreement in principle is good because it doesn't affect your credit score. And like you were saying, it's just a check, isn't it? To see whether you can afford the house that you want or not. So now moving on to the second stage, which is when you are now ready to buy. A lot of the times when you start looking, you will see some houses or flats or whatever it is that you're wanting to buy that then say leasehold or freehold. Now, I remember when we looked for our first house, I guess you already knew the difference, but I was like, leasehold, freehold, what's that?
Yeah. So obviously I had that unfair advantage of working in the industry, but leasehold and freehold is essentially when you're buying a property, right? You're buying the actual physical property itself, or the flat, the physical flat, and also you're buying the land that property is built on. So freehold basically means that the price of that property includes ownership of the land.
Right.
And so the mortgage would cover the property and the land in one lump because both the property and the land are one package.
Yeah.
So that's a freehold. I'm not going to get into the names at this point, but that's the name. Now, leasehold is then the word lease basically means that actually the property is yours, but the land is owned by somebody else.
Yeah.
And so in that scenario, what then happens is you have a mortgage for the property, but then you have something called ground rent for the land. Ground rent is then like an additional payment that you pay for owning a property on that land.
Right.
And so it becomes when you're now doing your calculations or when you're looking at properties online, you're then kind of bearing that in mind that a freehold property means that you own the property and the land, and the mortgage payment is the only thing that you need to kind of think about. Whereas if you're looking at a leaseholds are usually for flats, block of flats and stuff like that. So what tends to happen is with a leasehold, you may own the flat on the mortgage, but then you need to pay an additional ground rent payment to the people or the company that owns the land. So if you're in a position where you are buying a flat or a leasehold property, then just do your research to find out, okay, how much is the ground rent and how much would that cost per month or per year, just so that you're aware of the complete cost of ownership here. But that's really the difference between those two terms.
Right.
Yeah.
So moving on from that one, right? So you've decided, okay, maybe I want the freehold or I want the leasehold, whichever of the two you want.
Yeah.
You then maybe then come across the term loan to value.
Yeah.
Talk to us about LTV, loan to value.
To be honest, this is one of those things where I really think it's one of those internal languages, like between the bank and the lender and the mortgage advisor. I think between them, they should talk about loan to value. But sometimes they end up asking you like, oh, what loan to value do you want? And it's like the average person won't really know what that means. But loan to value is essentially the percentage of the mortgage that the lender is prepared to lend to you. In simpler terms, it's you have a house price of 200,000. You have a deposit of 20,000, so that's 10%.
Yeah.
So that means you are borrowing 90%. So that 90% is the loan to value. It's the amount that you're borrowing as a loan or mortgage to the value of the property. And as we said, this is normally 10% deposit and 90% is the loan to value. But coming back to what you said earlier about new builds, what you would then tend to find, some lenders will say maximum lending for new builds or houses built within the last 2 years is 85% loan to value.
Right.
What they're basically saying is you need a 15% deposit minimum to be able to borrow a mortgage up to the loan to value amount of 85%. So loan to value is basically how much they are prepared to lend to you based on certain criteria. So it's only important if they have a different rule other than the usual 90%.
Okay. So let's say I'm at the point where now I get all these terms and I'm now ready to actually then purchase my property. Got my deposit, everything's all good, everything's ready.
Yeah.
you will often hear, for people that are buying new builds, I guess it's slightly different. If you're a first time buyer and all you're buying is a new build, it's different. But if you're someone who's buying a pre-loved home, or you're selling yours and then buying another home, you often hear the term chain used quite a lot. So talk to us about chains and what they are.
So a chain is essentially a link between how many people are in the whole process of buying and selling the property. So if you're buying a new build house, there's you, the person who's buying the house, and let's just say you're a first time buyer and you're buying a new build. There's you, the person or the couple who are buying your property. Then there's the developers who have built the property and are selling that property. Now, the developers are not living in that property. They're simply selling it. So the chain is between the two of you, because you're buying the property and they're selling it. End of story. Pretty much like a car. There's one person selling the car, there's one person buying a car, and that's it. End of story. There's like one link in the chain. But then what can happen in property is, let's say you're selling your property.
Yeah.
And now I want to buy your property.
Yeah.
Right? So that's one link.
Yeah.
But then there's another link on the other side where you are buying a property from somebody else
who's also selling
their property.
Yeah.
And let's just say they are also buying a property from somebody else, but then maybe the person that they're buying from is not selling their property because they already live somewhere else.
Yeah.
Let's just say. So then we got one link and two links.
Yeah.
So then this creates a chain. So the chain is basically how many people are involved in this process attached to you. Now, the reason why this is important for you to understand is because the longer the chain, usually speaking, the more risks are associated with it. So you can imagine, let's just say between the two of me and you have agreed, like, okay, yes, I've got a deposit, I made you an offer, you have accepted my offer, and we are ready to go.
Yeah.
You make an offer to your seller, and they accept, and from that perspective, you're ready to go.
Right.
But then your seller has made an offer to where they want to buy, but their offer has been rejected.
Yeah.
Which then means that it has a knock-on effect, because they can't sell their property, which means you can't buy their property, which then means I can't buy your property.
True.
Because there is that knock-on effect. Or it may even be, the knock-on effect may come from, say, exchange of contracts, where everybody else is ready in the chain, but maybe I don't have my deposit ready yet. So then the fact that I don't have my deposit yet to buy your property, that affects your ability to buy the other property, that affects their ability to buy the other property. And it just, the chain creates that little bit of like risk to be like, maybe like everything has to be aligned together at the same time.
Yeah.
And any one of these people involved could delay or impact the chain at some point.
I guess it creates some sort of domino effect, doesn't it? If one of the dominoes or someone in the chain pulls out, it affects everyone that's involved in the chain. So it's always good to know who's involved in your chain and what's going on in the chain, because it just has a knock-on effect on everything.
100%.
So now, let's move on to the bit where you now buy the house, right?
Okay, yeah.
So you normally hear these two terms, actually, conveyancer and surveyor. Yeah. And sometimes they can be confusing, because you could use them both thinking you're talking about one thing, and it happens quite a lot. So talk to us about conveyancer and surveyor.
So when you're buying a house, there are two things that need to be done. And I will liken this to an example. So when you get a job, they do background checks or they get references on you. And that's kind of what happens here. So when you're buying a property, there's two sides of the camp.
Yeah.
So the first side is the searches.
Yeah.
So the searches are done by the conveyancer, or the legal side, which is the solicitors. And what they're really searching for is the background check around the area that you're buying in. So what they're checking at is looking at, say, okay, is there any flood risk in the area? Are there any development plans to build a new shopping complex or a new railway line?
Like the HS2.
Like the HS2 within your area that you're buying in. And all of these other sort of background checks. What's the water supply like between your house and to and from your house, basically? How is the water and the drainage system working? So what they're checking for is just the area around where you're buying. And the reason why they're doing that check is just to let you know that, okay, you're buying a property in this area. We have identified nothing, no issues.
Yeah.
Or we've identified that actually there may be a little bit of risk in this department or in this area. There was a flood 100 years ago. I don't know, something like that, where they just pick up things that you just need to be aware of.
Yeah.
If you're going to go ahead with this property, because they might pick up something that may make you not want to buy the property,
Yeah,
right?
true.
Because think about it, when you're viewing your properties on Rightmove or Zoopla, all you're looking at is the actual
Pictures.
building
Yeah.
and the pictures. And when you go to view the property, you're looking at the building. Very rarely do we then look at what's the area like, what's been happening in the area recently. So this is the purpose of the conveyancing side. They're doing the research on your behalf of the area itself and letting you know of any issues that you may need to be aware of, because the house will be fine, but the area might have some issues that you just need to be aware of, which could sway your decision to buy the property. Yeah. So that's the conveyancer side. Then on the other side, we have the surveyor. So the second thing that happens is what's called a survey. A survey is then obviously done by a surveyor, so kind of in the name, but this tends to be done by the mortgage providers. Right. The point of a survey is actually really asking the question: is the house that you're buying worth the price that you're paying for it? Yeah. That's kind of really the point of a survey. There's other things within it, but the idea is that, okay, the mortgage lender is trying to basically ascertain, are we giving you too much mortgage than the actual property is worth here?
Right.
And so the impact on your part might be that the surveyor might turn around and say, yep, that's fine. What you're buying it for and what we are willing to lend to you is in line with the value of the property from our checks. But they might turn around and say, actually, we think the property is worth less, so we are only prepared to lend to you this much money.
Yeah.
And if you want to go ahead and buy it, either negotiate a lower price with the seller, or you need to put more deposit in.
Right.
Yeah.
So I guess it's good to know the difference between those two terms, because I feel like if anything, they tend to be the ones that cause a bit of confusion if you're not aware of the mortgage or buying jargon and stuff. So it's great to know those. So there's terminology that's used, right, for couples when they're buying a house.
Yeah.
A lot of the times the solicitors, who are the conveyancer, will send you a form asking you, how exactly, because there's two of you buying this house, how exactly are you buying the house? Are you buying it as tenants in common, or are you buying it as joint tenants?
Yeah.
Now, for someone who's probably not come across that before and they're on their journey for buying their house for the first time, how would you explain that terminology?
Sure. This is another term that I really don't get the point. I don't get the word tenant, because I'm like, but I'm not a tenant.
I own it.
I'm the owner, right? But anyway, simple terms, a joint tenant agreement is basically where you and me, both of us, we own the property equally.
Right.
And there's no split. Like, it's 100% yours and it's 100% mine. And the impact of that simply means that when we sell the property in the future, we would share 50-50 the profits.
Right.
Either way. And it also may mean that if one of us was to pass away, the property then automatically belongs to the other person.
Right.
Because we both own equal rights to the property. But it's 100-100. It's not 50-50. It's 100-100.
Right.
Right? If that makes sense. Whereas tenants in common is then the opposite of that. It's actually where you state, okay, this is the percentage that I own.
Right.
And then this is the percentage that you own. So let's just say, for example, it's 50-50. I own 50%, you own 50%. But why would we do tenants in common? You may wonder. Well, it may be that we want to make sure that in the future, if we are to split up, we will get 50% each way. Or it may be that actually, when I die, I would like to hand over my ownership to my child, for example.
Yeah.
So that 50% that I own is going to be given to my child.
True.
So that's what tenants in common does. But some couples consider it when, say, for example, you're putting in a bigger deposit than I am, and then, obviously they're committed enough to buy a house together, right? But maybe they're not necessarily married, or maybe they are married, but they're also just kind of thinking to themselves, well, if it's split up, I'd like to protect the fact that I'm putting in the majority of the deposit here.
Right.
So they might say, okay, let's make it 70-30, because you're putting in 70% of the deposit, I'm putting in 30% of the deposit. We'll go into this house as tenants in common. I own 30%, you own 70%. When we sell the property in the future, you get 70% of the profits, I get 30% of the profits, XYZ. So that's the kind of difference between those two terms, which obviously you make a decision on which way you want to go if you're a couple, or you're buying a house to somebody else. And obviously you will get legal advice anyway from your solicitors about this.
Right. Yeah. So fast forward, I guess, to towards the end, or maybe the middle and the end, right?
Yeah.
Because you often hear the terms exchange and completion. And at times those two terms can confuse people.
Absolutely.
Like, oh, we're exchanging. Oh, we're completing.
Yeah.
So help us understand the terms exchange and
100%.
completion.
So I got confused by this. Even with my knowledge and all, I actually got confused by this because, I was thinking that exchange means, we exchange keys.
Yeah.
So I'm like, what's this other completion thing here? But okay. So when you make a bid on a property to say, or an offer to say, I want to buy this house, and the seller says, yes, you can buy this property at the price that you've said, happy with that, they take the property off the market. Now, at that point, that's when all of these searches and conveyancing and solicitor checks and all mortgage checks, all of these things are done. Now, whilst they're being done, in theory, you can still walk away.
Yeah.
In theory, you are still within your free cancellation period. Now, it is only until you then exchange contracts. So what you're exchanging is contracts, really. And exchange contracts means that, okay, now I own your property and you have sold your property to me legally. Legally, I am now bound to buy your property.
Yeah.
So exchange of contracts means that. Now, if I wanted to then pull away from that deal after exchange of contracts, I'll be charged hefty fees, basically. I'll still have to pay a lot of fees because I'm now legally bound to buy that property. I can't really back away from it. And if I did, there'll be some heavy consequences for that. Now, completion is basically the check-in date, like with the hotel. Completion is the day that you actually get the keys.
Right.
And you move out of your property and you move into the property that you've bought, and that's the day you get your keys. These two dates of exchange and completion might be a week apart, but they also might be months apart depending on your situation and circumstances.
Absolutely. So I hope what we've had to say today has been helpful to some of you. I remember when we were going through it the first time, some of those terms were coming up and they're literally like, going over your head. And you're like, what does that mean? What does that mean? Yeah. What does that mean? And we literally had to go and Google those things. But it's important when you're going through this journey or starting this journey to know that you will come across those terms, and it's important for you to know them because they all affect you. So it's important for you to know, what do they mean? Okay, so now we're exchange. What does that mean? Yeah. Oh, okay, now I need to get an agreement in principle. What does that mean? So it's important for you to educate yourself and be knowledgeable about all those terms. So we hope what we've had to say today has been super useful to someone. For those of you that are going through your journey for the first time, let us know in the comments section what other terms you've heard that you feel like, whoa, what does that mean? Because there will be other things that come up, but we hope this have been useful. Let us know what else you've learned today that you didn't know about before. We're super excited to have had this conversation with you, and we'll definitely chat to you soon.